We start today's market talk. In investing, as in many things in life, simplicity often trumps complexity. So take stock of your existing investments. How have they performed? Don't churn your portfolio in response to every market move or news headlines. There is a tendency to overcomplicate things, to constantly seek best strategy and best performing stocks oblique sectors. Market outlook. Uncertainty hangs heavily on the policymakers in the markets as the inauguration of Donald Trump as the President of United States for the second time approaches on 20th January. Now, this term of Trump is not about higher tariffs, strength of US dollars, inflation, or central bank actions. This term is about might is right, which is going to be the new geopolitical mantra. Problem is that America will be great again and other countries will suffer. And this time, China will not be the only target, but even allies will have to pay for protection. All nations will have to build their own economic and defense capabilities. Now, despite rate cuts, yields have spiked across all major economies uh, because inflation expectations have shot up. In addition, the sanctions on Russian crude have pushed up the crude prices beyond $80. Expectations of ballooning fiscal deficit in US have pushed up the US bond yields higher. Now US 10-year yield is touching 4.8. Yields in Germany and Britain are also rising. Rising yields in US lead to narrower spreads against emerging market yields. Then FI tend to sell off Indian equities in such times. The depreciation of the rupee has further strained the dollar returns for the FIs, which they generally used to earn in the Indian markets. Finance minister need to present a transformative budget. Investors will be looking for increased infrastructure spending, a commitment to fiscal prudence, strategic divestment of non-core public sector units, and measures to boost consumption and job creation. Meaningful tax reforms can help revive the market sentiment. There is a need to end excessive regulatory measures introduced by RBI, SEBI, IRDAI, and others. RBI will need to cut rates soon as monetary policy will have to do the heavy lifting to support growth in an environment of increased uncertainty. Uh, Fiscal stimulus is likely to come down in 25-26 budget as fiscal deficit will be lowered to 4.5. So in an environment of increased uncertainty, economy will need all the support that it can get. Now coming to US markets, they surged on Friday. Primary driver of the move was CPI, which surprised on the downside. Even the core CPI came down. Also, major banks have come up with solid quarterly results. Uh, US bull run is likely to continue on good economic growth, pro growth policies of Trump, more rate cuts, strong retail sales. Uh, so we'll have to watch for these issues. But like if you see here, the US 10-year yield was heading to 4.8 and then corrected last week to 4.6. So now it all depends on what are the latest recent policies, which how they're going to manifest for the new president. Similarly, with dollar index, it had gone to 110 level and then corrected from there. It has come down to that 109 level. So this is a crucial level. Now, if the Trump's tariffs are immediate, then the dollar will shoot up, and all the emerging market stock markets will come down. But in case the his tariffs are slow, or take time to be implemented and are not that bad as anticipated, then the dollar will weaken and emerging markets will do well. Brent crude was rising above the declining trend line. Now that has halted now. This is because why it was moving up, because the US crude stockpile have declined and US has put sanctions on Russia for to prevent their exports. But the Gaza ceasefire has limited the gains of crude. Gold also continues to go up because it's a play on uncertainty. So right now it is positive and above the rising trend line. Copper, after the correction, is bouncing back from oversold levels. So we'll have to watch as to what are the latest commentary from China and also what is the latest demand and supply situation. Bitcoin bounced back on Friday after correcting to 90,000 level to back above 100,000 level to a dollar. So this asset seems to be in momentum right now based on the policies of the incoming administration in the US. Nasdaq was up around 2.85% last week, so it is bouncing back from the 20 EMA. Similar with Dow, it was up 3.69%, strong momentum, and it has bounced from the lower trendline support. Now coming to India, India VIX was up on all days and went above the 16 odd levels. So right now it is above the 20 EMA, so it is looking positive, and it is driving the volatility higher. USD INR continued to go up. It went to 86.55 uh, last week. So right now it is headed much higher levels, and this is what is causing problems to equities. Now coming to Nifty, we had a full week of consolidation. So Nifty made a doji. Monday may start a uh, downside breakout, because right now, though it is slightly oversold, but it requires a trigger to conduct a kind of a short squeeze where none is visible right now. FI short positions have reached around 3.26 lakh contracts. They have added short positions. This is that historic oversold area from where markets have traditionally bounced, but uh, the markets can remain oversold for long durations. Now, coming to daily charts for Nifty, if you see here, Nifty has made a kind of a head and shoulder pattern and has broken below the neckline of the head and shoulder. And the technical target for this head and shoulder is around 21,600 level. So right now it is below even the 200 EMA and looking weak. Last week it was range bound and consolidated. So the low it made on Friday of 23,050 would be crucial. If that breaks, then lower levels up to 22,800 and 22,400 are possible, at least in the coming week or so. If you see the hourly chart, there was a big gap down on Monday itself, and Nifty made the low for the week. And after that, it has been range bound and closed below the 20 EMA after briefly going above the 20 EMA on the hourly charts during on Thursday. Nifty Bank again, the trend is faltering, and now it is below this trend line support which was there, or the neckline of the head and shoulder, and below the 50 EMA also. Uh, so this support zone has been broken, and range shift signal is visible on the RSI. So if you see here, RSI is declining. So now the range will shift to the lower levels. So if you see the daily charts, uh, it has taken support at 48,000, then bounced back, but then the bounce was sold on Friday after the Axis Bank result. So this level of 48,000 would be crucial. Otherwise, we'll head to this 46,000 level and test the lows it made on in June after the election results. Nifty IT, which seemed to be a strong subsector, has is also showing a range shift happening in the weekly chart. So it has broken the rising trend line support and is also below the 20 EMA now, close below that. So it is in a decline now, and I think it will come down and test these lows again. HDFC Bank has broken all the supports and is below the 200 EMA, and it's now consolidating around the 1630 out levels. So this level is crucial. If it holds above these 16,000 odd levels, where it had consolidated for a long time, even last time, this should be okay. Otherwise, if this level breaks, then it is headed to these levels of 1400 odd. Reliance, after decent results, has bounced with high volumes. It went up with a gap up on Friday. People had gone long on this, so there was a lot of closing of the long positions. Hence, it corrected after this, but it is expected to do well from here. And this is one stock which is going to provide some strength to the market. Infosys, after slightly weak results, has declined and now it is below 100 EMA in just one day. So now the next support would be this 1700 odd level where it had taken support last time. And if this support breaks, then it will test this 1400 odd levels again. Nifty Midcap has bounced from the lower levels below the 50 EMA. So it is above this trend line support. Similarly, the small cap index, again, it is above that. So broader markets seem to be doing well. Now I'll cover three stocks. First is Apar Industries. India's National Electricity Plan blueprint outlines an outlay of 9.2 lakh crore over 2022 to 32 to build our transmission network to support 458 gigawatt of peak demand by 2032. Very few companies cater to the spectrum of power generation, renewable energy, and transmission and distribution like Apar. It is one of the largest and fastest growing players in conductors and especially specialty cables and wires, and make conductors and oils a full-fledged play. Conductors serviceable market would be 3.5 to 5 lakh crore over 22-32 domestic plus exports, led by grid expansion as well as modernization efforts coupled with railway overhead lines. It has 50% share in HTLS conductors, ACCC used for reconductoring. ACCC is aluminum conductor composite core. It's a type of high temperature, uh, high temperature, low sag HTLS conductor. It is a type of that used in power grids to improve mechanical and electrical performance of transmission lines. Uh, Government targets to reduce transmission losses to 20% by 2030. This acts as a key driver for reconductoring since HTLS premium conductors, uh, they don't sag as such. So despite operating at high temperature, keep line losses in control, implying significant cost saving over time. Cables and wires serviceable market shall reach 2.1 lakh crore by 2032, assuming 12% CAGR over the next 8 years, led by both conventional plus new age areas driven by RE generation, distribution, defense, railways, auto, telecom, etc. Conductors profitability to sustain or pick up on the back of rising mix of HEC conductors. HEC is high efficiency conductors over 3 to 4 years, spurred by large investments in 400 to 76 kilowatt transmission lines. The transformer oil offering command a market share of almost 60% in the power transformer segment, that is for this company, and close to 40% in the distribution segment in India for distribution type transformers. It targets 30% of the transformers value with transformer oil forming 5% and CTC PICC conductors 25%. CTC is continuously transposed conductor and PICC is paper insulated copper conductor. Both are part of a transformer. Exports potential emanates from US infra capex plan of USD 1.2 trillion for revamping its aging transmission and distribution infra, and Europe's plan to expend euro 584 billion on grid expansion stability by 2032. Now, seeing their results, though they are having decent revenue growth of around uh, 12 to 15% over the last few years, but last year the margins had declined, so the reported profit was generally flat as the margins had declined to 8.7%, and there was negligible growth in EPS, which was generally at the same. But this year, the margins are expected to better, and there is going to be a decent revenue growth of around 16%, with profit also growing substantially, EBITDA margins improving. So this year, it is expected to do a EPS of around 272, and FY27, it is expected to do a EPS of around 339. So considering a mean of around 300, uh, at uh, at 30 times to 35 times, this can trade between 9,000 to 10,000, which should be fair value. All key ratios are improving. EPS growth is strong, around 27%. ROE is improving. EBITDA growth is also strong, and payout ratio is good. Why it has an edge? Firstly, it is in power T&D and RE, conductors, cables, and transformer oils. Railways, it provides copper conductors, XLPE, and elastomeric cables. XLPE is cross-linked polyethylene. They insulate high voltage electric cables. And elastomeric cables are silicon rubber cables used for railway transmission. Automotives, auto lubes, auto cables, telecom, optical fiber cables, and optical ground wire, defense, elastomeric cables, and specialty cables, and exports 49% of the revenue contribution in FY23. Uh, it was growing at around 6% CAGR earlier, pre FY21, with operating margins around 6%. And now the revenue growth has improved. So last 6, 7 years, it is now growing at 20% CAGR, with average operating margins also now going up and expected to edge higher. So now what is going to happen is the ROE, ROC are improving. It had shot up in 23-24, but it had come down because of higher input cost. But now it is expected to improve because of their higher margins. Uh, as per one of the estimates, their EBITDA per metric ton for conductors is going to go up to around 40,000 rupees for per metric ton for FY27, so which will help their margins. For cables and wires, also the EBITDA margins is going to improve, and similarly for oils and lubricants, EBITDA per kiloliter is also going to be higher. So with better EBITDA margins and better revenue mix, etc., they are likely to do a EPS growth of around 27% in FY26 and 24% in FY27. So a target price of around 12,700 has been given for them. Seeing their charts, this is in a very strong chart, making constant highs and lows. So there is not a negativity in the chart. It had dipped after the last quarter results, but then had bounced back very quickly. Now it has dipped. So somewhere around this 9,000 levels is a decent level to accumulate this stock. Next stock is Bombay Stock Exchange, BSE. Exchanges, NSE, BSE revenues on index options are linked to total traded premiums, and the key cost components are SEBI fees, which are linked to notional turnover, and clearing costs, which are linked to total contract volumes. As premiums are lower after the latest directions from SEBI on FNO, they are down around 10% compared to 35% to 70% decline in notional turnover and contract volumes. Premiums have declined less because the contract size has increased. Hence, product margins can benefit by 10 to 30 basis points for exchanges, leading to earning upgrades. As expiry date trading declined, traders hedgers have increased activity in larger ticket non-expiry trades of continued products, Average ticket size for industry has increased by 35% month on month in December, further to 3x versus November 24 in second week of January 25, which saw higher lot sizes implementation. Market share gains for BSE at 300 basis point has been lower than expected. It was expected to increase market share much higher, but that has not happened. Watch out for sustainability of the elevated margin levels for the industry and incremental regulatory action on F&O, because there are certain measures which are going to be implemented in February and April also. Now, if you see here, BSE has seen a 46% drop versus November 24 and average daily index options contract traded in January 25. But index option notional average daily turnover has also dipped uh, as compared to the highs it made in September, but it has dipped now in December. BSE index option premium average daily turnover has increased by 9% month on month, leading to improvement in its premium to notional turnover in December 24. So its margins have improved. So estimate is that BSE's index option premium average daily turnover to grow at 22% CAGR over FY 25-27 in spite of decrease in number of contracts, and option revenues will grow at 24% CAGR over the same period. So the costs linked to options are expected to come down by 20 basis point over FY 25 to 27, which will improve the margins. That is clearing cost and service fees, leading to option product margins improving to 70% by FY 27. BSE's revenues are expected to grow at 19% CAGR over the next 3 years, uh, led by healthy growth in equity derivative markets. So the percentage of derivatives in the total revenues is going to be increased from 47% now to 51%, while rest are going to be lower. Uh, Operating EBITDA to grow at 29% CAGR over FY 25-27, with margins expanding to by at least 10 basis point. PAT to grow at 23% CAGR over the period. Uh, so if you see here, profit after tax is expected to go up. This is in billions, so 1,300 crore, 1,600 crore, and 1,900 crore. So that is a substantial jump. NSE continues to dominate options with 84% market share in index options and 85% share in stock options. So NSE has maintained its lead, though its total share is coming down, but it has not changed substantially as such. So we'll have to watch for this. Nifty census accounted for 39%, 10% of index option premiums in November. So in November, Nifty was 39% of premium turnover, and Bank Nifty was 34%, while Sensex and BankX were 10 and 3. Now, post implementation of new F&O norms, Nifty is now 57%, so they have gained market share. Bank Nifty is now 22%, and Sensex from 10 has moved to 15, and BankX has come down to 1%. So there's not much of change in the market share of BSE. So their revenues are expected to grow at around 10-11%, but their third party clearing house expenses are going to come down substantially by around 55% in FY 26, leading to their operating expenses coming down and EBITDA margins improving. So EBITDA margin is expected to really go up by 11% to 56%. EBITDA is going to improve by 32%, and EBITDA margins are again going to go up by 10%. So leading to a profit increase of around 30% year on year for every year now. So this is the why this stock is in momentum. So this is expected to do around 94 rupees EPS this year, 118 in 26 and 143 in 27. So considering a mean here of around 130 at 40 times at 5,200, this is a decent level to accumulate this stock. Now, if you see here, this stock was kind of subdued, but then shot up after this new SEBI norms were announced uh, on expectations of higher volumes of trade in BSE exchange, and it went up. But once it came to be known that the volumes have not increased, it was correcting. But now, after this report of higher premiums, This stock moved around 1,000 rupees in the last week only. Last stock is Aurion Pro Solutions. Established in 1997, it's a global technology company having operations in banking products, automated fare collection, smart city, and data center of segments. Its geographical revenue mix includes India 93%, Asia Pacific excluding India 37%, USA 7%, MEA 3%. The company is further expanding into Europe through its recent acquisition of Phoenix SAS. Vertically, the company generates 57% of its revenue from corporate banking, retail banking, and fintech, with 43% revenue coming from smart city, transit, and data center segments. It categorizes its revenue into two verticals: banking and financial technology, and technology innovation group, smart city, data centers, etc. Revenue growth has been strong, robust, with 33.4% CAGR recorded in the last 3 years, while PAT has also doubled over this period. They hold strong intellectual property in corporate lending, transaction banking, and transit solution, catering to marquee clients in India and globally. It has strong capabilities in designing and consulting of data centers. It works with large colocation players such as Webworks, Iron Mountain, etc. Data centers in India are expected to grow at a 35% CAGR over the next 5 years. It plays a role in design and consulting segment, which constitute 6% of 23 billion data center market, accounting for 1.4 billion of the total addressable market for them. The main focus is on scaling the transit business, 35% of the business. Company has built strong capabilities to provide end-to-end solutions through both hardware and software integration, enabling it to win global metro projects. It will grow its revenue 2x from FY24 to 27, 31% CAGR. This will be driven by 37% CAGR in banking and 24% CAGR in TIG, that is Technology Innovation Group, over FY24-27. If you see their revenue has improved now, and it is expected to become nearly double over the next 2-3 years. So expected to reach around 2,000 crore in FY27, with a strong growth of 30% plus. EBITDA is also growing, expected to grow at 20% plus, and PAT margins are expected to grow at higher teens, that is 16-17%. EPS is expected to be around 48 in FY26 and 64 in FY27, taking a mean of around 50. So this stock can easily trade at 40 times considering the growth it is offering. So that target should be around 2000. ROE is improving now, 19-20%. ROC is also improving, and P is come down. Now it is in one segment is banking and fintech, where it provides solutions in retail banking, branch transformation solutions, wholesale banking, transaction banking solutions, and treasury and capital markets. The other is Tech Innovation Group, which is in data center, transit, and smart city. So it does various projects and various solutions for them. It has strong order book, expected to drive 30% revenue growth in the medium term. Clients are Delhi Metro, uh, Saudi Arabian banks, Chennai Metro, Asian markets, Municipal Corporation of Panvel, leading banks in Malaysia, Google, State Bank of India, Government of Haryana. So it's got wide targets in both the segments, that is fintech and TIG. Order book is strong, around 1100 crore. Revenue growth has been strong, so they are doing 30% revenue growth every year, actually sequentially now. So that is good. Data center capacity is expected to grow at 40% CAGR. So data center capacity growth is going to be big, around 41% CAGR. So expected to grow to 4,000 odd megawatt. Investments are roughly around 23%, 23 billion in India, USD billion in India next 3-4 years. And the designing and consulting, which is their part, is expected to be around 1.5 or 1.6 billion out of that. Seeing their results as compared to others, so if you see here, their ROE is higher than their nearest competitor in fintech or banking and finance, that is Intellect Design. And as compared to others, it's slightly lower, but it is expected to improve while valuations, etc., are slightly lower as compared to their peers. So it's a strong company. Mm, Now, seeing their chart, so it has been rising. It went up to 2000 and then it corrected from August, September onwards. It made a low of below 1500 and then it has been sideways, went up and has come down. So, somewhere around these 1500 levels, around 200 EMA, this should be a good level to accumulate this stock for long term.